Bismillahirrahmanirrahim. In the previous class, we discussed about international credit market. Then after that, we discussed about syndicate loans. After that, we discussed about international bond market, domestic bond, foreign bond, euro bond, and global bond. Domestic bond. Today we are going to discuss the last topic of this chapter, and it is international equity market. Just like we can issue bonds internationally, nowadays multinational companies, they are also issuing stocks in the international market. Suppose this is USA and there is a company from USA. This company wants to issue shares in this market, stock market of this country. Suppose this is Australia. Suppose this is China. Suppose this is UK. So nowadays companies, they can issue. This is a US company belongs to USA, but they are issuing shares on the stock exchange of Australia, on the stock exchange of what was that, this country, China, and they can also issue shares on the stock market of UK. So this type of offering, this is called international equity market. In addition to issuing stock locally, multinationals can also obtain funds by issuing stocks in the international market. So just like I told you that you can issue, companies can issue bonds internationally, nowadays they can obtain funds by issuing stocks in the international market. This will enhance the firm's image. One thing, that is, the image of the firm will be enhanced. Why? Previously they were issuing shares only in the US market here, so their reputation was only in the US market. But now they are issuing shares in the Australian market, in the Chinese market, in the UK market, so their reputation will enhance. And name recognition, and their name will be recognized all over the world. And diversify the shareholders base. Previously the shareholders of this company belongs to USA. The shareholders belongs to USA. Now this company, their shareholders are from Australia, their shareholders are from China, and their shareholders are from UK. So the shareholders base, it will also be diversified. Diversify the shareholder base. The stocks may also be more easily digested. Digested doesn't mean that people are going to eat the shares. No. Digestion means that previously if this company was issuing, suppose 1 million shares in USA. So 1 million, it is a huge amount of shares. So 1 million for the USA people, if they want to purchase 1 million, so it will be a bit difficult. But if they will issue 1 million shares in US market, then in Australian, in Chinese, in UK market, so combinedly this 1 million, it will be easy for the company to sell. So selling 1 million shares in USA, it will be difficult, but if the company, they are issuing these shares in 4 or 5 markets, so it will be easily digested, means it will be easily sold. Stock issued in the US by non-US firms or governments are called Yankee stock offerings. What does it mean? This is USA, a company from UK or a company from China or a company from Australia. They are going to issue shares in the stock market of USA. So if a non-US firm is issuing stocks in USA, this type of offering will be called Yankee stock offering. See, Australian company is issuing shares in USA, so it will be Yankee stock offering. Chinese firm is issuing stocks in USA, so it will be Yankee stock offering. UK firm is issuing shares in USA, so it will be Yankee stock offering. So basically, initially a Japanese company issued shares in USA, so they call it Yankee stock offering. So onward they gave it a name of Yankee stock offering. That is, if a non-US firm is issuing shares in US stock market, so that type of issue will be called Yankee stock offering. Market characteristics are important too. When you are issuing shares, so the characteristic of market, it is important. Stock markets may differ in size. The size of market is important. The number of participants in the market, it is important, because if the size is big, shares will be easily sold. Trading activity level, the important thing, what is the trading activity level? If trading is more, so issuing shares in that market, it is good for the company. Regulatory requirement means the laws of that stock market, the laws in that stock market, it is also important when a company wants to issue stocks in outside the country. Taxation rate, the most important one, it is the taxation rate. What is the tax rate in that country in which we are issuing shares, and the portion of individual versus institutional share ownership, means the stock market in which we are issuing shares, what is the percentage of individual investors and what is the percentage of institutional investors. Because institutional investors, if these are more, so what will happen? Institutions, they are rich, they have money, so they can easily buy shares. And individual investors, so institutional investors, it is much more better than individual investors. So we talk about international equity market. So international equity market is a market in if a company is issuing shares outside the country, so that type of share will be considered in international equity market. And nowadays companies can issue shares in international markets. What will be the advantage of this issue? This will enhance the firm's image. First thing that is important is the firm image will be enhanced. Their name recognition, means previously they were well known in USA, now it will be well known in other countries as well. And diversify the shareholder base. Previously the shareholders belongs to one country, now the shareholders will belong from different countries. The stocks may also be more easily digested, and shares will also be, if you are selling shares in one market, so it will be difficult that these shares will be sold in that one market. But if you are selling the same number of shares in different markets, so the digestion means shares will be sold easily. Then we discussed about Yankee stock offering, that if a non-US firm is issuing stocks in USA, so that type of offering will be called Yankee stock offering. Then we discussed that if you are issuing shares, so market characteristics are important. That is the size of the market, trading activity level, regulatory requirements, the taxation rate, and proportion of individual versus institutional share ownership. That in some markets institutional share ownership it is more, and in some stock markets individual owners, these are more. So this is the end of this chapter, and we are going to start the next lecture, the next chapter, that is purchasing power parity. What is basically purchasing power parity? Purchasing power parity, shortly we call it PPP, states that the exchange rate between one currency and another is in equilibrium when their domestic purchasing powers at that rate of exchange are equivalent. Basically, PPP means that if the purchasing power in one country and the purchasing power in other country, these are same, so their exchange rate will also be same. See, states that the exchange rate between one currency and another is in equilibrium, means the exchange rate will be in equilibrium when their domestic purchasing powers at that rate of exchange are equivalent. If the purchasing power in these two countries, it is what? It is equal. In short, what this means is that a bundle of goods should cost the same in UK and Afghanistan once you take the exchange rate into account. Means that the exchange rate will be equal in two countries. A bundle of goods should cost the same, means there is a bundle of goods, suppose, so it will cost the same in UK and Afghanistan once you take the exchange rate into account. Suppose take an example that suppose this is UK and this is Afghanistan. So see what is he saying, that a bundle of goods should cost the same in UK and Afghanistan once you take the exchange rate into account. Yes, suppose here is a tin, Pepsi tin or Coca-Cola tin. Suppose the price in Afghanistan is 20 Afghans. And the price in UK of one tin, it is suppose £1. So it looks like that in UK it is cheaper and in Afghanistan it is costly. But the main thing that is important is the exchange rate between these two countries. Suppose one UK pound, it is equal to 20 Afghanis. So now see, 1 UK pound is equal to 20 Afghanis. So in UK its price is £1, in Afghanistan its price is 20 Afs. So see, the prices are same if we took the exchange rate into account. Previously, when we were not considering the exchange rate, then it was looking like in UK it is cheap cheap mean arzan, and in Afghanistan it is what? It is costly. But when we took exchange rate into account, so 1 pound is equal to 20 Afghanis. So in UK, the Coca-Cola tin, it is for 1 pound, and in Afghanistan the same the same tin, it is for 20 Afghanis. But when we took the exchange rate into account, so suppose convert 1 pound to Afghanis, so it will be 20 Afghanis and the same 20 Afghanis in Afghanistan. So the price is what? Same, both in Afghanistan and in UK. So if the prices of a bundle of goods are same in Afghanistan and in UK, so this situation is called purchasing power parity. Parity basically means equality. So purchasing power parity, it is a situation in which a bundle of goods in two countries, the cost of that bundle of goods in two countries, it is what? It is the same. Here is an example. First, suppose that 1 UK pound has a currently price of 10 Afghanis. It is an example. So 1 UK pound, it is equal to 10 Afghanis in the forex market. In the UK, let us suppose that cricket bats are sold for 40 pounds. What is the price of cricket bat in UK? It is 40 pounds. While in Afghanistan, they sell for 150 Afghanis. And in Afghanistan, the price is 150 Afghanis. Since 1 UK pound is equal to 10 Afghanis, then the bat cost 40 pound if we buy it in UK, but only 15 pound if we buy it in Afghanistan. Now let's have a look at this. UK, Afghanistan. Here the price is 40 pounds. And here the price is 150 Afghanis. Now what is the exchange rate? 1 pound, it is equal to 10 Fs. Now either convert Afghanis to pounds or convert pounds to Afghanis. Means 150 pounds converted to 150 Afghanis converted to pounds. So see, it will be 15 pounds. So the price of the cricket bats in UK, it is 40 pound, and in Afghanistan it is 15 pounds. Or if you want to convert it to Afghanis, so 40 multiplied by 10, because 1 pound is equal to 10 Afghanis, so it becomes 400 Fs. And here what is the price? 150 Fs. So there is a big price difference in these two countries in cricket bats. Now what will happen next? Clearly there is an advantage to buying the bat in Afghanistan, so consumers are much better off going to Afghanistan to buy their bats. Now since here in Afghanistan the price is 15 pounds and here in UK the price is 40 pounds. So what will people do? From UK they will go to Afghanistan, will buy the cricket bats at 15 pounds, will come back to UK and will sell it for 40 pounds. So what will be the advantage? These people, they will earn a huge sum of money. For today it is enough. Inshallah, in the next class we will discuss about this in detail, that here the bats are costly and here the bats are cheap. So what will people do? They will go from UK to Afghanistan, will buy bats and will come back to UK and will sell it here in Afghanistan. But in the next class then we will discuss about this in detail. Okay, have a good time.